taxation is theft. And like, is it theft? Okay, like without taxes, without reasonable taxes, we don't have, the counter argument to that is without reasonable taxes, we don't have any infrastructure. We don't have roads, court systems, that sort of thing. Right?
The key word is reasonable taxes.
Reasonable.
Like,
right?
I don't think 43% is reasonable amount.
And what's my opinion on taxation is theft? And after doing this job for a couple decades, right, and traveling the world and seeing different taxation systems, I was like, I would actually agree that some taxation is theft. Like, I would actually, there's different forms of taxation. Some of it is fair taxation, and it's the mechanism of taxation. And really, when I get down to it, it's like personal income tax, I think it's theft. I think I'm on board with that. Like, I think, if I had to define like personal income tax, it's like, yeah, it's kind of theft because there's really no way out of that. There's just no way you can sustain a living and not pay it, right?
Yeah.
And there are other countries in the world who don't assess personal income tax, who are in better fiscal position than they have a better fiscal position right now than Canada, and they're not charging personal income tax.
Yeah, they're charging a VAT tax or a consumption tax.
There's user fees, and there's sales tax. There's reasonable corporate taxes. Okay, the government is actually involved in for-profit industries that fund the government. And there are examples of that in the world, and so I can kind of get behind that, right? But at the end of the day, we can sit here all day and argue, is tax theft? And guess what happens to your net worth? Nothing. Doesn't matter what I think. It's not going to change. So I have to learn how to play this game, right? Okay. I think it's more like 43% alcohol, gas. Anything over 250 is 66%. Okay, anything over 250 is not 66%. Stop listening to the American YouTubers who read a headline and misunderstood capital gains tax. Any gain over 250K, 66% of it is included in your income at your marginal rate. So you're not paying 66% on a capital gains tax. Okay,
it's just the inclusion.
You're paying. The tax system sucks, but it's not 66% on gains. Okay. The inclusion rate. Pretty surprised it's not above 55. This is the average. And so trying to ascertain and calculate what is the exact tax for the average, boiling it down to one number, 41 million people in the country. It's hard. Like, there's a degree of subjectivity on this, right? And so could it be 55 in your situation? Yeah, it could, right? But I mean, the more important part is, how do we get it to 25? How do I get to 20, right?
Yeah.
That's kind of what we're here to do. It's government incorporated in BC. They use ICB Insurance Corporation to fund policing. Yeah, okay. Yeah, I mean the communist car insurance in BC. Yeah, I guess it's there. So, but I mean, I generally hate most insurance, and that's you learn to hate it in my job because
it's kind of a scam.
You see all the insurance fees that my clients pay, and I hear all the horror stories. Like, yeah, they're very happy to take all your fees, but the minute you want to collect, just wait. You know what I mean? And it's like I would say 1 out of every 100 clients that we have, they have some sort of insurance dispute where they've been paying, dutifully paying their insurance, and then when it comes time to collect, when something goes wrong, all of a sudden the insurance company forgets who you are. Like, who's this guy? Who's this guy? I swear we didn't insure you for that. It's just it's just going to do anything they can to try to get out of paying. So the false assumption with insurance is when it actually comes time to collect, that they're going to pay willingly or in a timely manner. So that's I have those issues. So caution, that's the unspoken risk about insurance. Okay, let's get to the breakdown. Here is the break. How do you get to 43%? Okay, only 31% of that. So the average Canadian, their total cash income is $109,000. Only 31% of that tax is actually personal tax. On average, okay, that's what they're paying. Okay, the other 21.5%. Payroll taxes. This is your CPP. This is your EI. Okay. These are very, and everyone forgets, it's like for every dollar you put into CPP, your employer puts in another dollar. They could have paid that to you, but they didn't have it. Your employer had to pay that, okay? For every dollar you put into EI, your employer's put in $1.40, okay? So you don't see that on your pay stub, okay? You're not going to see that on your pay stub. People just wildly underestimate how much your payroll tax is, right? And it's one of the biggest things that people can come to the realization is like, how do you get out of that payroll tax system on earned income? Ideally, you want to get all the way to the end and you're making money off of assets appreciation.
Right.
But, that's easier said than done. You usually have to earn your way into those assets. Okay. And if you're a T4 employee, you're paying 21.5% in payroll taxes on that income. That's really squeezing people. Okay. Whereas if you're self-employed and you're incorporated, you can actually opt out of those. Okay.
Yeah.
The CPP with the planning, the CPP, the Canada Pension Plan, or as I like to, I've permanently renamed it in my head as the Canada Pension Ponzi. It only works. Of course, it's underfunded. It only works if more new people enter into the system. And so I'm permanently going to call it the Canada Pension Ponzi.
Yeah, they
until they fund themselves.
And they have to enter the system and pay taxes.
Yep.
They can't just come into the system and not pay any taxes, right?
If they are fully funded, I will retract my comment if they somehow get to fully funded status where every dollar they have to pay out, they have in reserves, with a reasonable growth rate. But that's not what it is. It's underfunded. They need more people to enter into the system. Okay. So if you are self-employed, now, do I think everyone should be self-employed? No. I actually don't think everyone should go out and start a new business. One of the lines that really, I heard someone say once and it made me think is well, the last thing the world needs is another small business. That's right. You need to join forces with other people. Okay. And so the higher probability of success is go work for a company where you have a chance of ownership. That is a better, higher probability of success. It's do we help entrepreneurs from cold start here? It's of course we do. But I can't deny the probability of success. The probability of success from a cold start is very low.
Very difficult.
It's very, very difficult as opposed to buying an existing business or working for someone who has, who plans to cut you into the ownership structure. It's that's a much higher probability of success. And now you start having a predictable income, and if structured the right way, if everyone's on the same page in the ownership group, it's guess what? You're not paying that 21%. And that's massive. That's just a massive amount. You're talking 21% dumped into some inefficient CPP program that's, getting you a 4.3% rate of return when inflation is 8.2%. Real inflation. I mean real inflation on the real money. You could have just bought the ounces of gold and got 8.2% over the last 25 years. Now you can get out of that and you can deploy that 21% in things that go up in value by more than 8%. Okay, that is life-changing. Even if they never increase their income level, they will. This is where people on median income can easily redirect that 20% into efficient assets that go up in value and earn a real rate of return. And guess what? They're multimillionaires. That's it. That's it. Just that one change, right? Mm-hmm. Now, the temptation can be sometimes is, we can save people the payroll taxes that they pay, and now they just go and increase their lifestyle.
Right.
If you do that, maybe the CPP would have been better because at least you got your 4.3%, right?
Yeah.
But if you just go buy a new truck, guess what? That truck's going to zero, has a negative. It's not going to be worth anything, right? You take another vacation, it's with the savings, that doesn't do it. But if you just take that savings from the payroll taxes and you actually invest it wisely, you're going to the top 20%. You're going to 1.2 million or above. That can realistically happen. Sales tax, yeah. Most of the purchases that we have are going to be subject to sales tax, and there's not much we're going to do to get the average person out of that. You're still going to pay sales tax, okay? So we look at the ones that we can save. It's we can shave some percentage points off the income tax.
Yeah.
Likely. we can usually obliterate those payroll taxes. But sales tax, it's like, unless you never want to buy anything and kind of live a lower, a lower quality of life. It's like you're probably going to end up paying sales tax. You come to Alberta though, paying 5% is kind of nice. It's like, I talk to clients who come here sometimes, and they lived in other provinces, and I was like, man, I can't get over it. It's like, we only pay 5%. I was like, yeah, it's like, it's a real thing, the Alberta advantage, right? So, and then you have property taxes.
Oh yeah, property tax.
Property tax is at 8.2%. Okay. What's really hard to grasp sometimes is people have to understand is that often luxury real estate has a lower rate of property tax than the median income stuff. So
okay, what do you mean by that?
I mean I have a condo here in Edmonton. Okay, I have a condo here in Edmonton. And I have another condo in Vancouver, okay? The condo in Vancouver is worth approximately 5 times the value of the condo in Edmonton. 5, let's call it maybe a 4 or 5, in that range, okay?
Sure.
4 to 5 times the value of the condo in Edmonton. I pay the same property tax on both of them. The exact same property tax on both of them, okay? And people just have to, like, different jurisdictions pay different property taxes, okay? For the high price of real estate in Vancouver, the property tax is actually very low. We're talking like less than 0.5% of the value of the property. It's like, why? Because there's a bunch of high priced real estate in a very small area, and the roads, and the services cost relatively the same.
And don't forget, they have a land transfer tax when you purchase a property. So does that kind of balance that out somewhat?
Yes and no. If I don't know how to invest, right, the conventional investment is like, it's just like you heard, buy low, sell high. Okay, buy low, sell high. That's just like buy low, sell high. It's like, no, you replace buy low, sell high, buy, borrow, die. I'm never selling. I'm never paying it. So do I have to pay the transfer tax when I bought it? Yes. Am I ever going to pay it again? No. Because when you buy assets, you want to buy assets that you think are going to be good assets for 100 years that I can pass, with tax planning to my kids tax-free. Okay. That is the goal of this thing. So yes, I paid that land transfer tax, but I didn't, I wasn't one of these ones who, they get on the cycle where they think they're going to trade in their property in Vancouver every 2 or 3 years. Like, yeah, you're going to pay the land transfer tax every single time, right? And so you're going to get burned by that. And so, like, you have to shift your thinking. It's like that is not the goal. Like, you're trying to buy assets that you could hold for 100 years. It's not about getting which asset's the best performer for the next year or 2 or even 10. It's which one can get you a good rate of return for 100 years and not pay any tax. Because it's not the rate of return that matters. It's the rate of return after tax. That's what matters here, okay? Yeah. And so if one's walking towards a tax bill and the other one's not, it's like I can wait till the value of the property goes up in value and I can borrow against it. That's not a taxable event.
Right. Yeah, because there's no tax on debt.
Okay. And then you have your various the profit tax. That one is hard for people to understand. Like, what is a profit tax? But like fairly, it's like you have to assess something that most of the things that we buy you're buying from companies that are for-profit companies that are subject to tax. And if they don't pay the tax out of the goodness of their heart, they're going to raise the prices, right? And it's like all these, like, the Jagmeet Singhs of the world. It's like, oh, we're gonna tax the grocers. Like, they're just gonna pass it on to the people who buy the stuff in the store. Like,